We did see a rally. I mean, we saw it turn around tremendously. If you look at the chart, they knocked the hell out of silver. It was down considerably, and then actually within a half hour was in the green, went up, and gold pared back roughly half of its losses. So there was some of that involved. But again, the amount of contracts that were dumped to push the price this low also would trigger other automated sell signals that a lot of these funds will be automated by black box trading systems where levels are breached, they immediately trigger sell stops, and that's what would have happened. So a lot of people were sold out of their positions while they slept at night, and those that were knowing what was coming were able to come in and gobble things up on the cheap. Not all of it, but enough to certainly benefit some of the players who knew what was coming. Look, we blew through 2,000, never challenged it. Blew through 3,000, never challenged it. Blew through 4,000, still haven't challenged it. We may, but as we said, support a step back in. But when you follow the narrative, the conventional wisdom of the mainstream, and some of what they say is legit based upon what I just said, and blowing through these averages, 50, 70, $100 a day moves, that's unprecedented to the upside. But when we look at what happened in the middle of the evening last night, where in the thinnest part of the trading cycle, when New York is fast asleep, someone or some entity or a coordinated effort dumped a massive wave of futures contract onto the market. Again, when New York was fast asleep, this drove silver under $50. It knocked gold down $100. But then something interesting happened. I mean, this was shock and awe, Michelle. This is a drive-by shooting, right? Any trader that would be stupid enough to dump that level of futures onto the market at the thinnest trading segment of the day, when there's virtually no liquidity, would be fired and shot, and probably not in that order. And it was specifically done for effect. But what was interesting is that we saw players come in almost immediately right after this happened and push the price right back up. Now, is that physical buying? Is it knocking down the paper price and coming in and buying the physical to cover the shorts? Maybe. We don't know who it is. We have an idea. Watching or reading Michael Lynch gives us a good idea, a little bit of a snapshot. He comes out and says straight out that this was an engineered crushing by the paper shorts. They're behind it, behind the scenes. But someone came in and snapped up at a record pace. He thinks it's Bank of America and Morgan Stanley. The interesting part about that is it was a month ago where the chief investment officer for Morgan Stanley came out and said, yeah, the 60-40 mantra we've been talking about for so long.
In what one could describe as a sharply timed intervention, a massive futures block was dumped during the quietest hours of trading, when liquidity was minimal and price sensitivity maximal. Silver fell under $50, gold lost some $100, as though triggered deliberately. But almost immediately, a counterforce emerged. Buyers stepped in, scooping up undercut prices with speed. These two moves, massive paper sell-off followed by aggressive purchase, suggest coordination, or at least strategic timing. It invites the question of motive. Was this simply profit-taking, or something more engineered to shake positions and influence sentiment?
We think we should sell 20% of the bonds, 60-40 being the Wall Street steadfast way of investing, 60% stock, 40% bond. He says, no, let's do 60-20-20, 20% bond, 20% gold. Well, Michael believes that there are footprints of Morgan Stanley and Bank of America, whose high price analyst, Michael Hartnett, whose newsletter I believe is at least $10,000 a year, only speaking to the institutional traders, came out and said, no, it should be 25, 25, 25, 25, 25% stock, 25% bond, 25% short-term treasury, 25% gold. Bank of America last week raised their target on silver to over $66 or $67 for next year, with an interim price, medium price between now and then, or an average price of somewhere around 57. He goes on to talk about that since October 17th, 6,000 new immediate delivery contracts were written, which is all but a record for this late stage of the delivery cycle. And he goes on to say, if the pace continues, it could be one of the biggest delivery months ever on record, challenging the February and March deliveries. So in other words, the market got bombed by paper in the middle of the night when no one is trading and New York is asleep, which provides all the liquidity. But yet someone came in and gobbled a whole bunch up. And at the same time, we saw 11,000 paper long contracts closed out. So this is a very unusual drive-by shooting for effect type of sell-off. Yet some of the fundamentals that are cited by the mainstream are true. It's a half truth. Yeah, those things are true, and the markets can stay overbought for a long period of time. But to ignore how the sell-off occurred and just simply say this is profit taking is ridiculous. It's just not good reporting, is what it is, because any normal trader would have spread that out during the most liquid time of the day in New York trading over hours or even days to maximize that level of return, not dump it on for effect. And that's exactly what happened. And I think that is something that should be taken into consideration as we continue to talk about what's going on.
Observers point to major financial houses. Commentary from analysts suggests long-standing net sellers flip to buyers. Firms like Morgan Stanley and Bank of America are mentioned as having made large physical purchases, hundreds of thousands of ounces, over days. These moves coincided with the dump of paper futures. So the thesis goes, drive down the paper price when liquidity is weak, then enter on the physical side at advantageous levels. Whether that is speculation or hedging, the scale of activity implies large-scale actors, not retail. This dynamic matters in assessing short-term shocks and long-term positioning.
Would have been, in the access market, could have been in between. It was probably in between the closing of Asia and the opening of London, somewhere in that period of time where the main price setting is done in New York. The traders who would provide the liquidity, the big banks, would be found in New York City. And if you are going to execute a trade, you don't, if you wanted to sell $25 million worth of a stock in a thinly traded market, you don't just dump it onto the market to cascade the price and get the worst settlement. You would do it over time, slowly, maybe through multiple entities, not trying to spook the market, but by dumping it into a market that is thinly traded, meaning not in New York and not even when London is fully operational or right as China is closing. You're talking very few players are providing liquidity. It is going to provide the worst possible settlement you could possibly get. It's done for effect. It would not be the way that any trader with half a brain cell would ever try to maximize return for their client or for their own position. And it is specifically done to drive down the paper price.
Okay, so you did mention, though, that Bank of America purchased some of this. We know that definitively. But
Michael Lynch says that Bank of America and Morgan Stanley, which had been dormant for a long time, or actually net sellers, flipped from selling. And he believes that they are two of the largest purchasers that came in and snapped this up. Now, a lot of this is he has a way of figuring it out, and I think everyone should check him out. Read him on his Substack and on X. He does a great job of analyzing the inflows and the outflows and who's buying and who's selling. But the bottom line is, I think what we take away from this is that there were some big players who scooped up. And is it scooping up physical to cover short positions below 50, below moving averages, or at least below trend lines? And I think that's actually possible, because what we see is the buying of, in the last 3 days, by Morgan Stanley, 196,200 ounces, by his estimation, in the last 3 days of gold. So, when you talk about knocking the paper price down to create the lowest or worst possible settlement to drive the price down, and then buyers coming in to scoop up, I mean, that just reeks of coordination, of suppression, of a ulterior motive, rather than doing it the way any normal person would do, and that would be to slowly sell your position to maximize the return instead of the antithesis, what we saw.
From a technical vantage, both gold and silver remain in strong uptrends above their 200-day moving averages with no confirmed lower low in view, silver even nearing oversold territory, which could hint at a rebound. Meanwhile, sentiment is charged. Bullion is no longer just a hedge, but a destination asset. According to the World Gold Council, gold grew 26% plus in the first half of 2025 across major currencies. Supply concerns, central bank buying, and safe haven demand all remain intact. Yet the odd pattern of the sell-off forces a rethink on simplistic profit-taking narratives.
We did see a rally. I mean, we saw it turn around tremendously. If you look at the chart, they knocked the hell out of silver. It was down considerably, and then actually within a half hour was in the green, went up. And gold pared back roughly half of its losses. So there was some of that involved. But again, the amount of contracts that were dumped to push the price this low also would trigger other automated sell signals that a lot of these funds will be automated by black box trading systems where levels are breached, they immediately trigger sell stops. And that's what would have happened. So a lot of people were sold out of their positions while they slept at night. And those that were knowing what was coming were able to come in and gobble things up on the cheap. Not all of it, but enough to certainly benefit some of the players who knew what was coming. What is it? And again, some of that would go in line with what we are being told, the conventional wisdom. Look, what matters? Supply is still tight. Central banks are still buying. Nothing's changed. Debt, wars, money printing, it is all continuing. And maybe when you take a look at what's happening around, a government shutdown, being criticized by the UK for the problem with our banks and the fragility within it, problems again that are starting to creep up in the repo market. Gold's getting noticed by Reuters and Bloomberg, and all of this commentary shedding a light on gold. At the same time, things are a mess here in the United States to a degree that I think perhaps maybe the players that have ulterior motives, whether that be to continue to accumulate or whatever their reasons were, I guess to me, it's we're not going to really know, because all I can tell you is that it's as illogical as wearing a parka in Death Valley in July to dump that kind of metal onto the market at the most inopportune time. And it was done specifically, I think, to create an effect. Yet at the same time, what is the motive? What is the motivation? Is it the U.S. government coming in and really not wanting the light to be shown upon gold at that level because they're still trying to accumulate it, or other entities, other banks that are getting margin called, looking at severe stress in the London market, trying to drive the paper price down to protect themselves, to cover their positions? We could pick a million reasons why it's happening, but to me, the why is less relevant, as is the how it happened. And in any of these instances, if any of these players wanted to do things legitimately, wouldn't have been done the way that it was done. It was done to rattle.
The backdrop couldn't be more volatile. Central banks continue to hoard gold, the dollar shows signs of softening, and geopolitical shocks are multiplying. Major institutions project could approach $4,000 by mid-2026 and even $5,000 in certain scenarios. For example, the Bank of America raised its 2026 gold target to $5,000 Australian. Meanwhile, unrest and policy uncertainty add premium to non-yielding metal. The question is no longer if, but when the next leg up begins, and what triggers matter most this time around.
The market. And maybe it was to, the retail investor. Over the last several weeks, I was just in Aruba for 8 days. I never saw the ocean for more than 30 minutes because we were working nonstop. Business has been accelerating tremendously. It's starting to catch the eye of the mainstream and of the public. Maybe that's not what they wanted to see. This was a flush. Now, at the same time, look, a flush, you could argue, would have been inevitable after 9 weeks of going straight up. and moving in a way that freaked a lot of people out. Never seen anything like this. But to your point, gold is no longer overbought as it was since late August, which is a good sign. It hasn't quite yet reached oversold, but what's interesting, silver has also confirmed an uptrend. Both of them have been an uptrend of a 200-day moving average, both of them continuing up. We haven't seen lower lows yet, but what we see with silver now is that it has already nearly reached its oversold levels. And that's, something very bullish, a technical indicator that should say that maybe the flush in silver has stopped. And in the short term, we should expect it to rebound. We could see a little more weakness in gold because even though both are no longer overbought, silver technically is no longer oversold. Gold, not quite there yet. So from a technical standpoint, sure, there is some merit in what the mainstream says. The application of how it came about is flawed. And to not bring that up is only telling half a story. And I think that's the part that the mainstream really is divisive about, and why so many people never understand what's happening, because they hear what they're saying and there's logic to it. But if they understood how it was actually implemented, they might look at it with a cross eye.
Having dissected the run-up, the maneuver, and the context, what does it mean for investors and observers? First, timing matters. Moves in illiquid hours can distort price discovery and raise questions about fair value. Second, scale matters. When large banks are accumulating, the flow data needs close tracking. Third, reset your lens. Traditional narratives, e.g. inflation hedge, remain valid, but here we also have structural shifts, digital asset competition, central bank diversification, and shadow balance sheet pressures. For anyone tuning in now, this isn't simply about buying gold, but about understanding the interplay of physical, paper, strategy, and policy.
The Federal Reserve Chairman was just recently at a summit. I don't know where it was. I heard the sound clip, and they were asking him questions. And I don't know if you have. Sorry.
We can pull that up if you're talking about Scott Bessent speaking and being asked about.
No, not Scott. Scott's the Treasury Secretary. I'm talking about Fed Chairman Powell, and he was just at a conference recently, and he was being asked by the moderators, and she said, "Look, this is an audience question, and it's one that everyone wants to know. Would you care to comment on the price of gold?" And his answer was, "No, I would not like to comment on the price of gold." He completely brushed it aside. And so there, look, rising gold has implications, and implications for the United States, implications for the dollar, implications globally. So I think that there's a lot more to it than just what the mainstream is trying to talk about. You sent me an article today that talked about the gold prices fell by 5.7%. and making it the largest one-day drop in since 2013, and they call it a 4.5 sigma move. In other words, such a large move happens in one out of only 240,000 days in a normal world. What we saw in that kind of a drop is highly unusual, and when you realize it was dumped at the most inopportune time to create this type of sigma event, it starts to reek of desperation of creating a narrative where all of a sudden the one that you speak of, where everyone from Reuters to the New York Post is talking about gold, maybe things are moving a little too fast for the big players, some of which who are still trapped in short positions that represent all but an existential threat to their survival if things get too far out of hand.